Welcome to Opal TV. Today I'm in Incline Village, which is in Nevada. I'm together with Ted Parkhill, the founder and CEO of Incline Investment Management. Ted and his team have been running a global macro strategy with a track record of over 5.5 years. And they're also working on a couple of interesting new strategies. But before we talk about those, please Ted, give us some background about yourself.
I started my career in the long-only space, and I learned perhaps became somewhat cynical about portfolio managers being paid a lot of money to have an opinion about which direction the markets were going in. It was really refreshing for me because I crossed the street and went to work for one of the legends in the business. His name was Mr. John Henry. And John today is better known for his ownership of the Boston Red Sox, Liverpool Football Club, etc. But he was one of the original systematic guys in the space, and it was really an opportunity for me because it just made so much sense. It made sense to have a systematic approach to markets in general. And along the way, I started to realize that there were different ways of doing it, and I started to form my own ideas on what mattered to investors, whether that was the exposure to risk or the importance of non-correlation in a portfolio. I had the good fortune of moving out west just before the financial crisis in a sense, and I came across my partner and CIO, Todd Hurlbut. Todd also trained under one of the legends in the space, a guy, one of the original market wizards, Ed Seykota. And Ed was one of the original Commodity Corp guys, and Todd trained under Ed. We came together realizing we shared similar philosophy in respect to the markets. We created our systematic hybrid strategy together, and what it is, we call it the hybrid because there are two engines. There's the equity engine and the futures engine, both trading systematically. So instead of a gas engine and an electric engine, we have these two components working simultaneously. And so that's what we've done. We've created a strategy that makes sense for investors from a diversification standpoint. The genesis of the strategy really was formed from our belief that there was a better way to manage cash. Many of the managed futures CTAs, they'll have like a 15% margin to equity on the portfolio. And then in the old days, you could take that 85% cash and invest it in T-bills, and it was a profitable strategy out of the gate. That wasn't the case back when we were getting started. So we were looking for a way to enhance the returns, and that was the genesis. So that we took 50 of the 85 and applied it to our systematic equity engine. And to us, that's worked brilliantly in a sense, because what's become a very difficult period for most systematic managers and managed futures in general, CTAs in general, our equity engine has done very well. It's actually been the major contributor. And of course, that would be the case in the bull run that we've had since we started. Our managed futures engine has been a bit of a drag on performance in a sense. It's been in neutral or reverse, where to extend the metaphor, our equity engine has been in sort of second to third gear through this period. So from a relative outperformance standpoint, we've done particularly well, which gives us great sort of reassurance that what we've built makes sense and that it works. In addition to that, we've been able to deliver our objective of non-correlation. Currently, at this point in time, we're hitting it spot on. And we're doing it with controlled vol. We're doing it with what I call equity-like vol. So that's more modern-like equity-like vol, sort of in the 14-15% range. So we're pleased with what we're doing. We also believe that there's going to come a time when markets turn. And if that happens, people are once again going to be really pleased that they have that exposure to strategies like ours. Because who knows what's going to happen when we look at the elevated levels of the equity markets and even the real estate market here in the US. I look to the Canadian real estate market and it's highly elevated. So we don't know what's going to happen. We don't predict that things will crash. This bull could continue for another year, another 2 years, we don't know. But what we do know is the value of diversification, and that value could prove itself over the next few years.
So Ted, what do you actually trade? What specifically, what markets, and what's your holding period? Tell us more about the actual strategy.
The actual holding period tends to be medium to long term. So we can trade any of the market, and that includes both the futures and the equities. It depends. What's really important to keep in mind when you're talking to a systematic manager is because we're systematic, we have a stop on every trade. So we know exactly how much money we're going to lose, which is almost counterintuitive to many investment managers. They're trying to figure out how much money they're going to make. For us, it's more important to, from a risk management standpoint, to know how much we're going to lose. And we've stripped the ego out of the decision making because we're systematic. So with that in mind, it could be anywhere from short period of time, usually 1 to 3 days, or anywhere up to sort of 3 to 6 months, depending on the directional or the sustainability of the move itself. And remember, we're directionally agnostic. We can actually follow the markets if they're going up, so we'll be long. We can also follow the markets on their way down, where we can be short, so we can make money in both directions. And that's sort of the beautiful part of having exposure to a strategy like this, is that we aren't tied to one direction. We aren't absolutely committed to just long only. We can make money in both directions, and that can be really, really important going forward, but it's also a contributing factor to why we end up with non-correlated results. So when it comes to building a portfolio of diversification, we trade over 70 different global futures markets in the futures engine. We trade US equities in the systematic equity engine. On the futures side, we're trading all the 6 main sectors. We're trading precious metals, we're trading agricultural markets, I call them the ags. We also trade the energy markets, so all of the commodities. And we're also trading all of the financials as well. So we trade all the major currency markets, we trade all of the bond markets, the global bond markets, and the global stock indices as well. So we have broad exposure. Now, we say we trade them, and we do, but I think a better terminology is tracking. We track all of these markets because we don't trade them all the time. If a market's flat or it's not moving or it's just choppy, we're not going to have a position in that market. We're not going to be in that market at that period of time. So I like to say we track them. But at a certain point, if the market starts to move, whether it's either moving up or it's down and it's broken out of its trading range, we'll take a position. And going back to what I said earlier, we'll actually know exactly how much money we have on that position. Okay? So sometimes I get asked, am I an expert in all these markets? And the answer is no. We're a systematic manager. We don't need to be an expert in the markets we trade, but what we do know is that market fits the model in which we're trading. So sometimes, what do I know about lean hogs? I have them for breakfast every Saturday. Beyond that, I am not following the weather in Iowa, or I'm not following the weather in Ghana if we trade cocoa, which we do. I am not worried about the fundamentals of any specific market, but what we are concerned about is the directional move of those markets, and that's what we trade. And that's why it makes so much sense from our perspective to have, it's so much more prudent to have an approach like ours when you're following the markets. Why fight the market when you can actually follow it instead?
So tell us more about your investor base.
The investors that come to us are really primarily investors looking for more diversification. So for the most part, we look, high net worth investors have found us. And they recognize that there will come a time when they need different exposure, that they're happy to have that non-correlation. Non-correlation is a weird concept that a lot of people don't understand. And we like to think of it as sort of like a school of fish. If everything goes together, the whole school goes up and everyone feels great. They don't feel so good when that whole school turns down and takes a deep dive. And so we think of it as in that way. In some ways, we could be considered the shark because we can go in any direction and we can follow the direction and still get a really good meal. And so that's our view on markets. And so in terms of investors, they're the ones that are looking for something completely different to protect them if things go awry. And it goes back to sort of modern portfolio theory. If you add a non-correlated asset, even if it's a riskier asset, then you can actually drive down your overall portfolio risk and increase your overall portfolio return. In our case, when we set out to build the systematic hybrid, we actually built a portfolio that's going to have sort of level volatility with the equity markets. We're not shooting for the 30% vol like many of the CTAs often can live with. Not every investor is comfortable at that level. We like to say if you own equities, then you can own our strategy because it has similar risk profile. The difference is that we produce non-correlated returns. What does that mean? It means there's no relationship. If the stock market's up, doesn't mean we'll be up. If the stock market's down, doesn't mean we'll be down or up. There's no relationship. And that non-correlation actually has value to the overall portfolio. In addition, what we've recognized is that there's a community of registered investment advisors that actually get this, that actually understand the value and power of non-correlation when you're adding it to a portfolio. We've done some internal studies, and when we just look at a 60-40 split of assets, which many broker-dealers recommend still to this day as sort of the safe recommendation for their clients, we add a 20% allocation of our strategy in, and it has the potential to reduce a portfolio risk by 40%. It's very compelling, and there are some sophisticated RIAs that, like I said, that get this. And so one of our objectives is to take our message to the RIA community here in the US and offer our strategy to them. We happen to be available in a number of very popular platforms that RIAs access. We think that that's a convenience where they can charge their customary management fee on advisory fee, as they like to say, to their clients. But the most importantly is that our strategy can end up on a consolidated client statement as well, which is the key for doing business with the registered investment advisory world.
I think you're also working on new strategies, new approaches, right? Tell us more about those.
We actually are looking at some new strategies that we want to introduce, because one of the things we recognize that not everyone wants the blend or the hybrid, as we call it. And so there are a number of investors that just want sort of more specific products. So we actually are looking at launching some futures only product. We have one new strategy that's trading only 4 distinct futures markets. We have one strategy that we're looking at introducing that tracks 100 different futures markets and will be trading at 20 to 30 of them at any given time. So the futures only just has a little bit of different profile, but there's 2 common themes that we have with these new strategies that we're introducing. One, they're all systematic. And 2, the objective remains that we want to deliver non-correlated performance, because we see that as being the value add. So one of the other markets that we're looking at with great interest is the cryptocurrency markets. And there is a Bitcoin futures contract that we are following and creating a strategy that applies to our existing models and dropping in the Bitcoin futures contract into our existing models. And we're very encouraged with the results thus far. We also think it's a great opportunity for investors that want exposure to the crypto world but don't want to just take on the long only risk. It's exactly what we do. It fits our philosophy, because we don't believe you should only have a long only exposure to any market. It makes sense to us that if you're going to invest in something, why not have the opportunity to profit on the downside as well? And as many people realize, and there are a number of skeptics when it comes to cryptocurrencies, that it could be, our modern day version of the tulip fever. Maybe we're in that. We don't know the direction that this market is going to take, and it seems to us to only be prudent for us to have the opportunity to short the market as well, because our belief is you should be able to profit in either direction.